With multiple big crypto firms taking major blows in recent months, the sector that promised an alternative to the traditional global financial model now faces existential questions. The pitfall started last year when Terra USD and Luna crashed, losing all of their value overnight and wiping out $45 billion from the crypto market in just a singular day. Lately, the woes have been heavily weighing upon the crypto market, and questions about its survival in the long run have been raised. A year ago, investors were over the moon, describing Bitcoin as the future of money and Ethereum as the world's most important developer tool. NFTs were exploding. Coinbase was trading at a record high, and the NBA Miami Heat was just into its full season in the newly named FTX Arena. That was at the peak of crypto. Rather than acting as an inflation hedge against, inflation, which is at a near 40-year high, Bitcoin has proven to be another speculative asset that bubbles up when proponents are behind it and plunges if enthusiasm melts and investors get terrified. In a blink, the FTX exchange sank from a $32 billion valuation down to bankruptcy as liquidity dried up, customers demanded withdrawals, and rival exchange Binance ripped up its non-binding agreement to buy the company. The FTX founder, Sam Bankman-Fried, admitted to the charges against him and the company and stepped down as CEO. An expert noted, looking back now, the excitement prices of assets were definitely getting ahead of themselves and trading far above any fundamental value. As the downturn was so fast and violent, many have proclaimed that digital assets are dead. Whether crypto is forever doomed or will eventually recover, the slew of negative incidents exposed the industry's many flaws and served as a reminder to investors and the public why financial regulation exists. Bankruptcies have been upbeat, coming fast and furious to the crypto sector, and thereby leaving clients with crypto accounts unable to access their funds, and in some cases vying to retrieve pennies on the dollar. If this is indeed the future of finance, then it's looking rather vague. Crypto in its nature was supposed to bring transparency and transactions on blockchains which can be tracked. We didn't need centralized institutions because of the presence of digital hedgers to serve as the single source of truth. However, this particular narrative has thinned out. Michael Saylor, executive chairman of MicroStrategy, said, "Speaking for the Bitcoiners, we feel like we are trapped in a dysfunctional relationship with crypto and we want out. The industry needs to grow up and regulators are coming into this space. The future of the industry is registered digital assets on regulated exchanges, where everyone has the investor protections they need." When Terra USD and its sister token Luna drove below the $1 mark, a different kind of panic was instigated. The peg had been broken, confidence dissipated, and more than $40 billion were wiped out as a result of Luna's collapse. All of a sudden, it was as if nothing in crypto is safe. Apart from Bitcoiners being trapped in a dysfunctional relationship, according to Saylor, other investors have been caught in the thick web of fear and skepticism about crypto. The leading cryptocurrencies tumbled in value, and on the macro front, inflation had shown no sign of easing. The central bank remained dedicated to slowing the increase in consumer prices. In June of 2022, the bottom fell out. Leading platform Celsius paused withdrawals because of extreme market conditions. Binance also halted withdrawals, while crypto lender BlockFi slashed 20% of its workforce after more than quintupling since the end of 2022. Also, prominent crypto hedge fund 3 Arrows Capital defaulted on a loan worth more than $670 million. And FTX signed a deal giving it the option to buy BlockFi as a fraction of the company's last private valuation. Then, the bankruptcies followed. 2023 came in and here we are, battling with the setbacks in crypto banks and exchanges. There are so many hard pills to swallow and investors are definitely pulling out fast. Also, Elizabeth Warren, who has emerged as a lead lawmaker on crypto oversight, is trying to build support behind a bill that would have sweeping implications for the industry through tougher anti-corruption laundering restrictions. Simply put, Elizabeth Warren is branding herself as the scourge of crypto, and she's not doing it alone either. Crypto advocates are resisting Warren's push, and some dismiss her as an outlier, but her budding partnership with the GOP lawmakers reflects broader forces that are positioned to unite progressives and conservatives, watchdog groups and bankers, who all share a common cause to want to derail the unfettered growth of crypto. Crypto advocates have tried to reject Warren's anti-money laundering bill in the strongest possible terms, tagging it as an unconstitutional threat to privacy. Warren's attempt to stake out a clear position and a swell of support on crypto regulation will be a factor that top lawmakers will have to battle with if they want to achieve new legislation aimed at digital currencies. Notably, Elizabeth is a long-time and almost predictable opponent of cryptocurrency. Her hostility towards crypto is tied to her long-standing concerns about consumer fraud, which had also led her to build the Consumer Financial Protection Bureau, or the CFPB for short, after the 2008 financial crisis. So far, the crypto market has been a world where fortunes are made and lost faster and has taken quite a tumble from its late 2021 peak. Some of the reasons for these dramatic price declines vary from coin to coin, but they all have a few headwinds in common. The cyclical nature of the crypto market resulted in broad ebbs and flows in value. Many investors have lost faith in crypto as a valid asset class due to a threat of scandals and financial meltdowns. Well, there is no need to shudder with fear. Digital currencies and blockchain networks are still capable of influencing financial systems on a global level in the coming years. As long as the long-term investment thesis holds strong, there might be a few strategies to usher crypto into their next upswing. As stringent as Elizabeth Warren's bill is, it is necessary. Governments at the end of the day really need to get some stronger regulations on the crypto business in place. And that may be a difficult point to concede with because you might be thinking that regulations kill innovation, stifle the free market, and give more power to the government, leaving less control in the hands of the regular citizens. But more regulations have to be bad for the crypto market, which was established on the ideals of individual liberty, less government influence, and more financial innovation. Things are different now than when crypto was created, however. Right now, cryptocurrencies are in dire need of some responsibility and structure. When it comes to cryptocurrencies, we are dealing with a wild west of industry, with little oversight and plenty of dubious players. Crypto investors have been learning this lesson the hard way, and as a result of repeated money-draining events like the FTX bankruptcy, the Terra Luna disaster, and so on and so forth. If the crypto community is desperate about attracting deep-pocketed institutional investors, it needs to work within a legal and regulatory framework that is more investor-friendly. Proper regulations will allow institutional investors and others to confidently put their funds into this sector, and we've all had enough with the heartbreaks. The rising interest in decentralized finance and Web3 applications is also key. This is where the real magic will occur. DeFi itself is big. We're talking about a new paradigm in finance, one that is decentralized, trustless, and open to all. Chunks of middlemen such as banks, insurance agents, and payment processors are about to be replaced by automated cryptocurrency systems. Money transfers will be faster, fees will shrink, and the whole financial system will soon be far more efficient. And let's be honest, who wouldn't love this particular idea? With the rise of DeFi platforms and applications, we are seeing the emergence of a new kind of financial ecosystem, one that is controlled by the people, not the banks. With more development in this area, we can expect to see some notable innovation and growth in the crypto market. And at the end of the day, the only legitimate reason for token prices to rise is an increase in demand for them. Blockchain and crypto innovation will soon thin out if no one wants a better financial system. But the world is passionate about a new deal, which should have a positive impact on crypto prices in the long term. If DeFi is rising, then crypto is not dying. And we can't forget we have the unstoppable march of technological process. Last year's big event was the Ethereum merge, and next up is the Bitcoin halving, scheduled for the spring of 2024. The number of Bitcoin that miners receive as their reward for validating transactions on the network will be cut in half, which sharply reduces the supply of other coins entering the market. In the past, this has paved the path for higher prices. The technological improvements in crypto are dragging it from the cold hands of death. It's more like a contention. Cryptocurrencies can spend eternity in a cloud if concerned efforts are put in place. So all we have to do is cheer for growth. But that's going to do it for today's video. Make sure you click on the subscribe and notification buttons, and we'll see you in the next video.